The stock market is now pricing in a nearly 100% chance that the Feds will cut interest rates by September. This is per the official CME Fed Watch tool. Literally, the odds are at 93.3%. So what does this mean for real estate investment trusts or REITs? And this is what I want to talk about in today's video. I absolutely love REITs. I own a few here in my portfolio. And why do I love REITs so much? And that's because if you're a dividend investor and one who seeks a lot of income, REITs are perfect for you. And that's because they have a rule where they have to pay out 90% of their taxable income in the form of dividends. So it's normal for them to have these really high dividend yields. But right now we're in an environment where REITs have not been that attractive of an investment because you could just go buy TLT or put your money in the money market funds and inside the treasury bills where you get a risk-free 5.5% yield. Why would you buy a REIT that, probably yields around 6% when you could just buy that risk-free? But we're now entering an environment where it looks like the Feds are going to cut rates, which means your savings account rates, the T-bill rates, the money market rates, they're all going to come down and investors are going to look for somewhere else to put that money. And I think there's going to be a rotation into these dividend stocks, into these real estate investment trusts. And that's kind of what we've seen over the past couple of days. We've had some insane performance here in the REIT sector. Like, check this out. I want to go over a few, in particular, a few popular ones. Like, check out VG Properties. This one has been really impressive. Look at these candlesticks. Literally a couple days ago, they were 27. And as soon as the news came out, like the CPI data, we went from 28 all the way up to 30. Like, this was crazy. And it's not just VG Properties. We also have like Realty Income going crazy. Like, check this out. This is one of the most popular REITs that I own. I own 30 shares of Realty Income, and they actually pay you monthly income. So it's awesome to see that you're collecting income and the stock is actually appreciating in price. Realty Income is also a dividend aristocrat. That means they've been rising their dividend for over 25 years. They've never had to cut it. They're also inside the S&P 500. But I want to show you one REIT in particular that I own and why I love this sector. This sector just seems to outperform, and that is the self-storage sector. Check out CubeSmart. This is the only self-storage stock that I own currently, but check this out. They're only a couple bucks off all-time highs. Look, all-time highs for them was $51 and now they're at $48. CubeSmart is one of the few REITs that have had some insane performance that it really acts like a dividend growth stock. Now this one has a kind of lower yield compared to its peers. Like, they have a 4.21% dividend yield, which may not attract as many investors. Like, we have Realty Income with a 6% yield, and this one doesn't pay monthly either, but I really love this one and they have appreciated in stock price so much. I actually own this one here in my Mumu portfolio, which I'll show you real quick. I want to be completely transparent. I want to show you every single stock that I own, how much I'm up and down on them. So we're actually now up 19% on our CubeSmart shares. So that's what's crazy. So I went on Realty Income and I wanted to see what people were commenting about this, and look at the popular opinion. Like, people are saying this comment right here: should I sell now and rebuy when it's down at 45? We have this guy down here named Kronk Stocks. He said he skimmed some off the top. He sold some Realty Income. There's also some other people saying that. And I honestly think that's not the right move right now. I think, in all honesty, we should be a buyer of REITs right now and not a seller, because this interest rate going down is going to be such a tailwind for this company and for all REITs, the whole entire sector. I mean, if you wanted to not pick out a certain REIT, you could just buy ticker symbol VNQ, or this is a ETF that holds a bunch of REITs. The dividend yield is 3.99%, and they have a fairly low expense ratio of 0.13%. But if you don't want to individually pick any REITs, this one will do it right here. I mean, if we look, like, this one has had some pretty solid performance even before the pandemic happened and even after. I now want to show you a quick misconception a lot of investors make when valuing a REIT or a real estate investment trust. And I also want to show you a REIT that I really want to buy right now. I really recommend this REIT right here, and this is ticker symbol MAA. But let me show you how to properly value a REIT. So check this out. A normal investor, when they look at a dividend stock, would look at the PE ratio. And that's actually incorrect for these real estate investment trusts, because the PE ratio is a multiple off their net income. And for real estate investment trust, we never look at the net income. We actually look at the net income plus we add back the depreciation and the amortization. So if we look at this stock right here, they made $147 million in net income. This is why we don't look at net income, okay? So look, they made $147 million of net income, and their dividend cost them $172 million. So if we looked at net income for this stock, it'd be like, okay, this company can never afford the dividend. And that's because we actually want to look at with something known as the AFFO or the core FFO, which is this number down here. And in the most recent quarter, it was actually $200 million. And as we can see that well covers the $172 million dividend cost. And if you're still like, well, the dividend payout ratio still seems kind of high, that's because these REITs, remember, they have to pay out 90% of their taxable income in the form of dividends. And so that's why they have these really high dividend yields. And I really like this one in particular. This one is in the apartment complex sector. So they own a bunch of high quality apartment complexes in the Sunbelt area. But if we average out the 4 most recent quarters, like look, if on average, they probably make $280 million a quarter, which is a fair average. So they make $280 million a quarter, and their dividend cost $172 million. So they do have some room to raise it. And this is another thing that I love about this REIT. It's that they have not diluted you at all as a shareholder. So a lot of REITs have to issue equity, issue stock to gain cash to buy new assets, but not this one. Look at this. You've only been diluted 0.32% year over year, but at the same time, your assets haven't changed from 1 year ago. You're at last year you were at 11.35, now you're at 11.47. But this company right here can just easily afford their dividend. Like look at this, we can look at it on the per share metric form. In the most recent quarter, they made $1.71 and their dividend cost them $1.47 per share. And look at how impressive their dividend history is. Right now their dividend is $1.47. They're going to raise it in 2 quarters because they raise it every single year. But literally, if you were a shareholder in 2020, you only got $1 per share. Now you got $1.47, which is a 47% increase in your payment. And this company, of course, can still easily afford to keep raising their dividend. So that's kind of why I like ticker symbol MAA. And let me now show you another one that I really like. And I'm going to tell you why I really like it. It's because I own it. So this one I might be a little biased about, but I want to tell you why I love CubeSmart more than all of the other self-storage companies. And that's because CubeSmart has specifically all of their locations or their best locations in New York City. And New York City in 2021 took away tax incentives for new self-storage properties, and all of the old self-storage properties are grandfathered into this tax code. So literally, if you're trying to compete with CubeSmart right now or in the New York area, you basically have a huge disadvantage. So the new supply problem that's hitting a lot of the properties hasn't been affecting CubeSmart as much. But anyway, let me show you their dividend history because this is super impressive. So look, in the most recent quarter, they made 66 cents in core FFO and their dividend cost them 51 cents. They have a 4.21% dividend yield. And let me actually visualize this for you. They have the exact same amount of assets from 1 year ago, so they haven't done any crazy dilution. Check this out. So look, they have the exact same amount of assets from 1 year ago, right? And look at this, their AFFO is actually up 10.81% from 1 year ago. It's super impressive. Anyway, remember this number, they made $150 million. Hey, I just have so much fun looking at these REITs and looking at the numbers. Make sure you hit the like on the video if you do too. But look, their dividend literally only cost them $115 million a quarter, so they can easily afford the dividend. And like I said, they have not been diluting you. Literally, you've been diluted 0.17% year over year, which is nothing. So that's why I really like CubeSmart. It's because of the self-storage industry. Remember, if inflation does come back for whatever reason, self-storage is month-to-month lease, so you can easily capture the inflation, and the tenants have to pay it. They have their stuff. Usually you have sticky tenants because most people who have a self-storage property don't want to go rent a U-Haul, get their friends, and get all their stuff out. It's usually a long time work. So yeah. And also, self-storage has historically performed good in all kinds of markets. Even when the economy is doing bad, there's a recession, people are moving. It actually helps self-storage. But even when the economy's booming, people are filling up their Amazon shopping carts. And here's the last stock we'll look at. This is realty income. This is a point that's really important. So, this says their PE ratio is a 52. That's, of course, like I said earlier, doing a multiple off their net income. What we actually want to look at is their price to funds from operations ratio, which is what I was talking to you guys about earlier. They're actually trading at a 14.7 times their core FFO, which is really fair. That's the multiple we should actually be looking at. So they're trading at 14 times their real money, their real number we actually want to look at. But yeah, thank you guys so much for watching. That was pretty much my video on the REITs. Let me know in the comments if you learned something. I'll make sure to respond to every single comment. Let me know what REITs you own, because congrats to every REIT shareholder. REITs are going to do amazing and already have done amazing. So let me know your thoughts in the comments. See you on the next one.